Hey, Amanda, thanks for taking out the time today and chatting with us. I really appreciate it. I've been, like I told you before we started recording, I've been listening to you and your tax advice for quite some time. So it's exciting to get you on the podcast and talk to you a little bit more in depth on, some strategies and some changes that we've seen, including, what you're doing now in business as well. So before we get into, the bulk of what's going on today with the taxes. Can you tell a little bit of our audience what you do?
Yeah, so what I typically tell people is I'm a CPA by day and real estate investor by night. So during the day, my husband and I operate Keystone CPA, which is a firm in Southern California. And we specialize in helping real estate investors nationwide on how to use real estate to save on taxes. And then by night, between cooking and kids and things like that, when the kids go to sleep, we is when we kind of tend to our real estate portfolio. So like a lot of our clients, we are real estate investors ourselves. So anywhere from
You there?
oh, you still there?
Yeah.
Oh,
Um, it
so I think
lagged
you
for
went black for some reason.
yeah for a few minutes, or I mean a few seconds. So let's see. So you guys, just to pick up from where we left off. So you guys run the CPA firm and then also invest when your kids go down to sleep. Just like I feel like the majority of small mom and pop real estate investors is they ultimately do some type of W-2 or self-employment, and then at night or on the weekends they do their investments, which is cool. So
Yep.
so when did you guys start the CPA firm? How long ago was that?
Gosh, I'm gonna say almost 15 years ago. So, my husband and I both worked at one of the big four public accounting firms in Orange County. And I was in the real estate group. So, most of my clients were the large developers, REITs, and my husband was in the high net worth individual group. So, effectively, he worked with the people who kind of owned those businesses. But it's interesting because for so many years, we ourselves never thought to invest in real estate. We were accountants for real estate investors, and it wasn't until we read the Rich Dad Poor Dad book when we thought, maybe this is something we can do too. And that's sort of how we got started in real estate for ourselves.
Yeah, I mean, I feel like so many people talk about reading that book and then it just skyrockets them into, a completely different venture and real estate investing or real estate investing full time. So, you guys are working for the Big Four, and then ultimately you guys transitioned after reading that book. How has the practice been, and having your being a CPA and then also investing at the same time? Did it Was it something that clicked right away, or did it take a while to build up on the clientele and also how to strategize your own portfolio?
Yeah, it's really interesting because we went through a period where we thought like we didn't want to be CPAs anymore. We wanted just to do real estate full time, get into multifamily, and kind of just stop doing tax stuff. And then we quickly realized that that really wasn't our passion to be like a full time investor. Between the two of us, we're always kind of like, okay, you do the real estate. No, no, you look for the deals. You look at the negotiation. And so we were both trying to just continue to do tax stuff. And when we were networking with investors, we quickly realized that there was a huge need, for kind of like you said, mom and pop investors who didn't even know that there were tax strategies that they can use to reduce their taxes with real estate. And so our business, Keystone CPA, kind of happened by chance. It wasn't our goal to like go out and start our own firm. It sort of happened because we realized that's really what we were truly passionate about, and that we had there was this huge need, right, for people who didn't have the same strategies or knowledge that traditionally some of the larger investment firms were able to access through some of the big four. And I think, we've been very fortunate to be in our position,
Yeah.
because we can sort of leverage the expertise and knowledge of our clients as well to see where they're investing, where the good deals are, and really try to grow our portfolio accordingly too.
Yeah. Yeah, for sure. I mean, I think that helps in any aspect of a business. You run into some clients and they're doing something, especially if you're involved in real estate on commercial agent side or residential. You'll run into one or two people ultimately that's going to put you into a different playing field for investments because they have a different strategy, something to open your mind to. So, I know a lot of people, and I brought you on just to kind of talk about some strategies for taxes, and put people into a position that they could win, especially saving taxes or being a little bit more strategic. So let's talk about, because some of our audience is lenders, some of them are agents, some of them are just strictly investors. So
Mhm.
could we talk to people that are basically self-employed, 1099, those people that are working as agents or lenders that maybe some strategies could help them save some money on taxes?
Yeah, I mean, for people making 1099 income, it really opens up the world in terms of tax strategies and savings, right? Because as a 1099 earner, you are a business owner in the eyes of the IRS. And it doesn't matter whether you're earning that in a corporation or an LLC or just in your individual name, it's a business for tax purposes nonetheless. And so what that means is when you hear about the code being skewed to allow benefits for business owners, that really applies to a lot of these 1099 earners, whether it's real estate commissions or somebody who's like an attorney or a CPA, right? It kind of works the same way. And the benefit of being a business owner is that you can write off a lot of your expenses that are associated with earning that 1099 income. Realtors, brokers, I know there's a ton of expenses that are incurred in terms of, from dealing with clients, potential clients, marketing, and all that good stuff. So making sure that you have a good way to track those, especially since commissions income is taxed very high. Not only do we pay federal and state income taxes, we also pay self-employment tax on top of that. So sometimes it could be, over 50%, right? Um, Depending on kind of the profile of that particular agent, let's say, um, typically if they don't have any other income, just purely 1099, it often makes sense to have them earn that money in an S corporation, to save on self-employment taxes. So, as an example, if someone made $100,000 of net profit, meaning commissions minus all their business expenses, business use of car, home office, after subtracting out expenses, if it's over $100,000, earning that commissions in an S corporation could save over $7,000 in self-employment taxes compared to someone earning that just in their individual name. So very powerful stuff, especially the higher commissions and money you make, the higher the possible tax savings.
Yeah, yeah, that's huge. I mean, I like how you broke it down simplistically, where it's $7,000. If you add that up, and it's $100,000 out of that, and as a so if you're working no other job and you're self-employed, for you as an agent and or lender, is it at that moment that you do, and could you go real estate professional on your taxes, and how does that look? Does that help, and does that go above and beyond what an S corp would do for you tax savings wise?
Possibly. So, if an agent is also an investor, right, meaning they own rental properties, then there's a huge benefit that if you're able to be a real estate professional for tax purposes, what it means is that you can use rental losses to offset taxes from your commissions income. For someone who's not a real estate professional, the rental losses typically offset other types of passive income. So, if I have profit on one rental, and I have lost on another rental, they can offset each other, but they don't normally offset, taxes from other income source. So for someone who's also a real estate agent, If you are a real estate professional, the rental losses can offset W-2 or 1099 income. I think that's a common misconception that people think because they're a real estate agent or broker that they're automatically real estate professional when it comes to taxes, and unfortunately, that's not true. So there are lots of real estate agents who are not real estate professional. So the term real estate professional only exists in the tax world, has nothing to do with your license or any of that. So to be a real estate professional, again, this is only important if you own rental properties. If you don't own rental properties, doesn't even matter, right? So if you own rental properties, real estate professional means there's a couple thresholds to meet. So one, you have to have at least 750 hours in real estate. That does include your hours as a realtor. So that's good, right? And then the other thing you have to meet is more time in real estate than your job. So if you are an attorney working at a W-2 job, that's going to be difficult for you to have more time in real estate. But if you are a real estate agent earning commissions income, that would be easy because your job is real estate, right? So those first two tests are pretty easy for real estate agents to meet. The one that's maybe a little bit of a hurdle for some agents that we work with is the third test, which is meeting material participation on your rental properties. So in this test, we're only looking at hours spent on your rentals. So you have to take out your commissions, being an agent, and all that other stuff. A couple different ways to meet material participation, but one of the most common ones is you spending at least 500 hours on your rental properties. So if you're an agent, you have, again, probably easy for you to meet the first two tests, right? 750 more hours than your job. Then as long as you can show that you spend at least 500 hours on your rental properties during that year, then you would be a real estate professional for tax purposes. And again, the benefit is that means you can use rental losses to now offset your commissions income.
Okay. Got it. Okay. What about, I was going to go here this quickly, but what about if you do have properties and cost segregation? Do you guys, I would assume since you're so investor friendly and heavy on your clients, is that something that you guys strategize right away? And I'll ask you that first and we can kind of dive deep in there. And then I have some other follow-up questions.
Yeah, so cost segregation, to define it real quick for anyone who doesn't understand, right? It's basically the IRS allows us to take faster depreciation on the building portion of our rental property. Instead of writing everything off over 27 and a half years, we're writing off a lot of that in the first couple of years. Immediately, year 2, year 3, year 4, right? Trying to write it off sooner and faster. And this is where you see significant tax savings where you have a cash flowing rental, but we're creating this huge tax loss. Ideally being able to use it to not just offset the rental income, but W-2, 1099, other income as well. The good thing about cost segregation is a lot of people don't know this. You don't have to do it immediately, meaning like I don't have to do it in the first year I buy a property. I could wait a year or 2 or 3 or 4, right? The key is I want to do the cost segregation in the year where I'm actually going to get the biggest benefit. So if last year I had high income, I met all the requirements, I can still choose to do it today to reduce my 2022 taxes. If 2023, I'm going to, lots of commissions, I'm going to be in a much higher tax bracket, I can choose to do that for the 2023 year as well. So there's a lot of options in terms of optimizing when you do a cost segregation.
Do you have to be going back to real estate professionals? Do you have to be a real estate professional, looked at by the IRS to do the cost segregation?
Great question. You don't have to be a real estate professional to do cost segregation. In fact, real estate professional or not real estate professional doesn't really impact any deduction. So a lot of times people are thinking like, oh, I can't claim a home office because I'm not a real estate professional. That's not true, right? Or I can't write off my car because I'm not. So anybody can take depreciation, write off cars, bonus, accelerated cost segregation. Anybody can do that. Specifically for cost segregation, though, the question becomes, should you do a cost segregation and should you do it this year? We only want to do it in the years when we can actually use the benefit. So if I have high income this year, and for tax purposes, in this context, high income is over $150,000, right? So if you and a spouse makes over 150, you're high income. If I'm a high income earner and I'm not a real estate professional, I may not want to do cost segregation, even though I may not want to do it because I won't be able to use that to offset my other income, right? But if I am a real estate professional, then I probably want to do it because I can use it today to offset my income. There's a lot of other things too, like if you sold a property, right, you might want to do a cost segregation because then you can try to wipe out the gain. So other intricacies, but I think the gist of it is anybody can do a cost segregation at any time. The question just becomes when is the best time for you to do it?
This follows up to my next question is, well, I know that it's going down. So you had 100%, right? And then now
Mhm.
it's 80% and it's 60, 40, 20, and then it's out. Um, what do you, even though, so let's say if it was me, last year was the biggest year and then this year was significantly lower.
Okay.
Um, last year, or sorry, last year was smaller, this year is bigger, but wouldn't last year benefit me if I had 100% versus 80% that I could take off? What's, you know,
Yeah.
weigh that benefit for us if you could?
Yeah, that's a great question. And we see this a lot. This is where planning comes in. So, in your example, you bought a couple rental properties, let's say in 2022 or before, right? 2021, 2022, bought a bunch of rental properties. But in those years, your income was lower. So, you don't have to do cost seg. You could if you wanted to, but you can choose not to do it. Fast forward to 2023, this is going to be a phenomenal year. Now you're expected to be in the highest tax bracket. Assuming you qualify as real estate professional or for some reason you're able to use the loss, what you would want to do is do the cost segregation for the 2023 year. Okay.
Okay.
Because the properties were placed in service in 2022, you can use 100% bonus depreciation on a cost segregation, even though you're doing it for the future year of 2023. And
Got
this is the reason why in 2022, you had a lot of investors, you probably saw this, a lot of investors aggressively trying to buy real estate and put them into service. And it's because of this reason. Even if they couldn't benefit or didn't want to benefit in 2022, they can do a cost segregation anytime in the future. And that building component, when they break it out, would be eligible for 100% bonus because it was placed in service in 2022.
Got it. Got it. Okay. And then, or if it was placed in service 2021.
Yep, you got it.
Okay. That makes sense. And let's see. So you could do a cost save if you worked, if you were kind of like you have the income from business, but then also you have investments too. You can do a cost save on that if you are an individual like that, correct?
Yeah, yeah. So, yeah, anybody can do a cost segregation. The question just becomes, can you utilize it to your benefit to offset your business income, or you had some capital gains when you sold another rental property? But yeah, that's always an option. Anybody could do a cost seg. It's not just restricted for real estate professionals.
Okay. Okay. And let's see. So let's say what's like the first 5 questions that someone should ask a CPA or a tax strategist when they sit down with them? And it could be 3 questions, but what sticks out in your mind, if they're coming to you and they really, just like if you went to a lender or a real estate agent or a lawyer, what are those 3 to 5 questions that you should be asking to really know that they're well-rounded in what you're looking for?
That's a great question. I'm actually putting together a list of questions. People keep asking me, like, what should I ask? So I think, most people, we fall into this habit of asking just like very generic questions. Like, do you work with real estate investors?
Yeah.
So most CPAs will say yes, right? Let's be honest. Everybody always has one client who owns a rental or rents out a room in their house. So I think a more powerful question could be, like, what are your successful investor clients doing to save on taxes? And then just let them talk, right? That's our goal. We want the advisor to talk so you can get an idea how much they know. And this is a really powerful question, I think, for 2 reasons. One, you get an idea what are the strategies that they think are cool that they're working on.
Mhm.
But also, when you ask, like, what are your successful clients doing? You get to hear the story of who they think is a successful investor. And so hopefully it's someone that's, done a lot of deals doing multifamily. If the story they share with you is, Jane Smith bought a rental property, or Jane Smith like rented out a room of in her house, that shows you kind of the level of expertise on what they think is like a successful real estate client. Right?
Okay. Yeah.
I think it's also important to find out if the advisor can work in multiple states. If you are someone who invests in a state different than where you live, right? So if you're in California, but you invest in Texas, you want to know, are you well versed in Texas taxation? What do I need to look out for? And see if they have something to share, right? Is there something interesting about Texas franchise tax and things like that? Um, so I think those are kind of the two main things. I mean, obviously you want to know, what the billing structure is. How do they communicate with clients? That's a big one. How often do we meet? When should I be calling you? Those are things that, you just want to know how they work, kind of transactionally as well, and whether that meets your needs.
Yeah. Oh, that's good. Do you guys, since you brought that up, do you guys work and have knowledge? I would assume since you work with so many investors across all of the United States, or are there specific states that you guys really know, California, Texas?
Yeah, we have clients nationwide. I think actually more than half of our clients now are outside of California. And I always joke, even for our California clients, they don't even, everything's done on Zoom now, right? Nobody wants to drive here in traffic. So yeah, we're very well versed in, kind of multi-state taxation. But yeah, there are just certain markets that a lot of investors are in, right? Florida, Texas, Tennessee. So we happen to be, more well versed, especially more well versed in that, just because lots of clients are investing in those types of markets.
Yeah, yeah, yeah. I mean, I think, the couple that stick out are, Texas, Florida, and then Tennessee. So, um, I mean, I know you can't completely, take yourself out of, California taxation, but since we're having the conversation and California is very highly taxed, what type of strategies have you guys been able to help your clients with to minimize those taxes on a real estate front?
California is very difficult. It is the California basically taxes worldwide income
Mhm.
of the residents of California. So truly the one way to get out of California taxation is to no longer be a resident of California. And I don't mean like, oh, I'm going to tell California I'm not here, but I'm actually here and my kids go to school
Yeah,
here. That's not going to fly. They've gotten very aggressive in those residency audits for that reason,
right.
especially since COVID, when people don't have to work from home anymore. But again, it's like, hey, my doctor's here, and so that's a little bit more difficult. The planning around California, oftentimes we look at it for big events. So maybe a little bit difficult, in terms of real estate, unless if you have, out of state transactions. But we have clients who, maybe work in the tech industry and they are expecting a huge windfall from some kind of stock transaction. That's going to be millions of dollars. So those are times where we can, if we know ahead of time, there could be planning that could be done where, okay, at the time you earn this income, you're no longer a California resident, right? I mean, there's nothing that says you can't move back to California, several years later.
Mhm.
But depending on the volume of the transactions, sometimes we have had clients who move out, specifically, as part of tax planning and tax strategy. But other than that, we talked about real estate professional status.
Yeah.
We talked about accelerate depreciation and the bonus depreciation, right, that we have. Really important for people to understand. California doesn't recognize either of those. So we don't recognize real estate professional. We don't allow for bonus depreciation. And what happens a lot for our California clients is, for federal purposes, they might get a huge refund or they don't pay any taxes.
Yeah.
And it's kind of shocking. It's like, wait, why am I still paying California taxes? And it's because California just, has a whole set of different laws. It doesn't follow a lot of these tax benefits that federal government gives us.
Gotcha. So, if you did cost segregation and you lived in California, properties are in California, um, you're still going to pay what you're going to pay for California tax, but you're going to have a huge tax saving on feds. Is that just to clarify that?
Yeah, well, I mean, you could do cost segregation for California. So cost segregation, let's say, we have $100,000 building. I'm going to break out components of that into specialty plumbing, appliances, things like that. So you could still do that. But the difference will be for federal purposes, for those assets, maybe you're writing off 100 or 80% immediately, versus for California purposes, you're writing them off over the next 5 years or 7 years or 15 years. So there's still going to be benefit, but it's just not as exciting as what you would see on the federal side, right? A decreased benefit, basically.
Got it. Got it. Okay. I mean, obviously, Fed's going to be a large, portion of that. So that's nice to at least get that. So maybe we can transition into chatting a little bit. We talked about cost segregation. I know that they've put some things and implemented some things where it's decreasing now. And so what have you seen? What do you guys know? Upcoming tax changes that would help us and real estate professionals or non-real estate professionals to kind of make sure that we're looking out for.
Yeah, it's really interesting because, maybe like a year and a half ago, you heard a lot in the media about this effort to take away unfair tax advantages for real estate investors and just people in real estate, right? And that target was maybe limiting or taking away the 1031 exchange, some of the qualified business income, where for realtor commissions, up to 20% of that could be tax free. So there's a lot of talks about that. But the good news is now, fast forward to 2023, really none of those have transpired. So we can still use all of these kind of, traditional pillar strategies to reduce income, whether it's from rentals or real estate commission. So that's really a great benefit of being an investor and being a realtor. We touched on earlier the fact that bonus depreciation, right, has decreased. Last year in 2022 was 100%. This year in 2023 is 80%. So it's a slight reduction in the bonus, but it's really important to understand that we're not losing out on 20% of our depreciation. We're simply delaying it. So last year, if you bought something for $100, you could write off the whole $100. But
Hmm.
this year, you bought the same thing for $100, you write off $80 immediately. That $20, you're still depreciating it over the life. So 5 years, 7 years, 7 or 15 years. So again, this is more of a delayed benefit, but we still get to keep it. But other than that, no real downside to tax changes currently. But of course, tax changes are always being discussed and coming. So have to see what that looks like.
Yeah. Yeah, definitely would have to see, as we come up in the next couple of years, what's going to change. If so, going back to real estate professional, you can't have another job. Just making sure that we, wrap that up. You can't have another job while you're trying to claim real estate professional, correct?
You can, it's just you're comparing your hours of that job to your real estate. So let's say you're a part-time substitute teacher, right? And you work 800 hours a year, but you're also a realtor and you work 1,000 hours a year in real estate, then it's still possible to be a real estate professional. We also see it a lot for married couples where maybe one spouse is a high income earner and the other spouse is a stay at home or not working full time. It's very possible for that other spouse, the non-working one, to try to qualify for real estate professional, managing the rental properties. And when you do that, because you file married joint return, the losses, right, from the rental of one spouse can offset the income from the other spouse. So there's a lot of different strategies around that. And short-term rentals have been, hot topic in the last couple of years. Short-term rental investors, you can actually use short-term rental losses to offset W-2 and other income, even if you're not a real estate professional. You do still have to meet that, material participation rule, like we were just talking about. So that's a kind of a loophole for a lot of people who are maybe both high income earners.
Yeah, yeah, yeah. No, that's good. And if I was, looking at, is there different tax structures for different asset classes, or is it pretty much all the same? And talk to us about that. So, like, if I was looking, a single family versus a tenplex,
Mhm.
what does that stuff look like for 'em?
Yeah, I mean, from a tax perspective, there's typically no difference. They are all considered rental income, right? Whether we have a, residential, commercial, midterm, short-term, long-term, they're typically all just considered rental income. So Entity wise, for tax reasons, it doesn't really matter. So typically we're looking at LLCs, partnerships, and not corporations, right? We don't really like to hold real estate rentals, at least. We don't want to hold rental properties in corporations. But yeah, other than that, those different product types are pretty much the same because they all just produce rental income for us.
Gotcha. And so you touched on a point that is always brought up. So if you're gonna if you're gonna buy your properties, what's the best strategy, or at least what you've seen tax purposes wise? We could, we'll talk to attorney about a protection wise, but tax strategy wise, LLC, S corp, C corp, or your individual name. What's kind of the best strategy there that you've seen and worked with?
Well, it's going to depend on the type of real estate income. So if we're talking strictly rental income, right? Rental income, again, different types, whether it's going all from single family all the way to multifamily, self-storage, medical center, medical building. Um, because it's rental income, it really doesn't have a huge impact for tax purposes. So, whether it's in your personal name or in like an LLC or a partnership, you're typically going to get the same tax treatment. So, but the reason people put those in entities is, like you said, for asset protection purposes, right? So that's pretty simple. And of course, for California, our California audience, there's a pretty significant cost when it comes to having legal entities. We have to pay at least $800 per entity per year. So you always want to look at the cost benefit analysis in terms of how many entities you form. So just because I have 6 rentals, I may or may not want to have 6 different LLCs, right? So figuring out like the cost benefit, working with your tax person, working with your attorney on that. A little bit different when we talk about active real estate. So earlier we were talking about an S corporation for realtor commissions.
Mhm.
So that would be the same if it came to people who are doing like fix and flip. So if you're flipping a property, you're doing wholesale. If you're a mortgage broker earning 1099 income, those, again, depending on kind of your total income, sometimes it's better to operate those in like a corporation,
Yeah,
typically C Corp or S Corp, to try to save on some of that self-employment tax.
yeah, yeah, yeah. Okay. And then let's see, for your personal residence, I know people have brought this up. If someone came to you and said, "Hey, can I put it in an LLC? Would it be better for tax purposes?" What type of strategy do you for personal residence, not rental?
Ooh, for personal residence, you just want to be very careful about legal entity. So, if you own your primary home, right? Let's assume it's not a rental. It's just like you're not house hacking or anything like
Yeah.
that. Just your home. What we get is we get the primary home gain exclusion. So, if you lived in your home in the last 2 out of 5 years, you can sell the home. If you're single, you exclude up to 250,000 of gain from taxes, and this is federal and California. And
Mhm.
if you're married, you can exclude up to 500,000. So it's a really huge benefit when you own it in your individual name. Okay. If you own it in an LLC, if the LLC doesn't file a separate tax return, meaning the LLC is owned 100% by you or you and your spouse in California, then typically that's okay. But it becomes problematic if you put it in an LLC that is going to have to file a separate tax return, because then you would lose out on that 250 or 500,000 tax-free gain exclusion. So
Gotcha.
typically it's held individually or kind of just in your living trust.
Okay. And you talked about house hacking. So what type of strategies would you talk to someone if they're renting out their rooms? How does that look like a rental property comparatively to a primary residence? So I buy it, 3.5% down FHA, and I move 3 people in, and it's a 4-bedroom house, and I'm living in the other bedroom. How does that look as a task strategist?
Yeah, I mean, it's similar in a sense that, to the extent you have rental related expenses, you can use it to offset the income, right, for those 3 bedrooms. So from that perspective, it works kind of the same way as any other rental property. But when it comes to losses, then it is treated differently because a part of that is your primary home. Oftentimes there are limitations to if you actually ended up with a net loss in terms of how those losses are utilized and what kind of income it offsets. So, in house hacking, that term is pretty generalized too, right? I know people use it in terms of renting out a room to renting out like a whole finished basement or like an ADU or even just like a duplex. And so, unfortunately, in each of those scenarios, there could be slightly different tax treatments and tax advantages or pitfalls there too. So, yeah, we could probably talk a whole hour about house hacking because there's so many
Yeah.
different variations I've seen people do it, you know?
Yeah, for sure. Well, so to follow up for the last point about 250 or 500 savings on the sale, is that still considered? So if I buy primary residence 3.5% down now, start house hacking it, and then I sell it in 3 years, can I still apply that to that sale?
Yeah, absolutely. You can still apply the primary home gain exclusion provided that you live there 2 out of 5 years. There are differences in how that exclusion works. Again, depending on if you rented out a room versus the whole basement versus like a duplex where you rented out, one unit or things like that. But yes, definitely, sometimes full exclusion, sometimes partial exclusion. That works in terms of house hacking. There is going to be depreciation recapture, right? So that when it was a rental, or the portion where it was a rental, if you took depreciation on it, that part is going to be recaptured. But the gain exclusion benefit does still exist.
Okay. Do you guys do, going back to cost segs and cost segregation, do you guys actually do it, or do you guys send it out to a firm, they do it, analyze it, and then you take it and process that towards that person's tax returns?
Yeah, that's a great question. So, we don't do the actual cost segregation study ourselves. What we do is we help our investor clients analyze whether and when to do it, right? Again, depending on the benefit and the cost. So we work with a couple different cost segregation firms. And so for our clients, it's up to them to decide who they want to work with. I know there are CPA firms who actually do the cost segregation study, and we've just shied away from that because a true study really is done through the eyes of an engineer, right? They're the ones who are able to break out the components of the building. I mean, I can kind of see what the appliance cost is, fixtures and furniture, but really, if you're talking about the structural stuff, I'm not an engineer. We don't have anyone in our firm who's an engineer, and so I like to just leave it to the professionals. For firms that's all they do is cost segregation.
Yeah, I mean, and that's the majority of CPAs that I've ever heard talk about it is just sending it out, and then that firm doing it and applying it to tax strategy wise. Um, for business, going back as a business professional, there were some things the past couple of years that you can't write off anymore. Can we go over those? Are those? I think it reduced the amount of like business lunches and stuff like that. I mean, you would know, you're way more versed than that. So talk to us a little bit about that.
So actually, I'm glad you brought that up. So in for those of you who haven't filed 2022 taxes yet, 2022 we were allowed to take 100% write-off on business meals. Previously, meals were limited to 50%. So if you spend $100 on a business lunch, you can only write off $50 of it, right? Only 50% deductible. But for 2022, again, if you haven't filed your tax returns, it's really important to split out business meals from restaurants versus non-restaurants because the meals from the restaurants are actually 100% deductible rather than 50%. And this is kind of a mistake that we've seen a lot in new clients that we're working with. The old CPA not differentiate between the two. By restaurants, I don't mean you like have to sit and dine in. It could be, DoorDash, it could be delivery, anything that's, generated from a restaurant from catering.
Mm-hmm.
So really the question is what's not a restaurant? Non-restaurant meals would be like if you went to 7-Eleven for a hot dog or if you bought stuff from the grocery, kind of made it yourself, right? So important distinction um, between those two. I think the limitation that came about a couple years ago is more with respect to entertainment. So we used to be able to deduct 50% of entertainment, so like taking clients to shows and baseball games and things like that. So that right now is currently not deductible, even though you might be doing business there. And so one tip is, when we do entertainment stuff, there's always food and beverage, right? Typically there's food and beverage involved. So what you want to do when possible is to split those out. Meaning, like if you're going to a baseball game, the tickets are the tickets. You have a different invoice or receipt for the food, because again, meals, at least for 2022, is still 100% deductible.
Gotcha. Okay. Yeah. Thanks for clarifying that. I know everything changes. I feel like even though it may be like 2 years and then it changes, and then like you said, it went back for the meals. But for let's see, audits, are there some things when you're talking to your CPA or someone comes to you that they may have done in the past, or things that you would say no, don't do because that's going to raise a red flag with the IRS, and what would those be?
Gosh, yeah. I mean, I've seen it both. So yesterday, I was working with a new client, and it was someone who was a physician that owned their own commercial property where the medical operations reside. And they, didn't do cost segregation. They didn't claim bonus depreciation. So probably overpaid taxes by about 100,000,
Right.
which is unfortunate because these are one of those things that you cannot go back and amend the return for. I also, a couple months ago, worked with a new client, also a physician, who claimed real estate professional, even though they weren't both, full-time doctors. Took a huge tax deduction for real estate. They did cost segregation, all the right things, but they missed out on that one little fact that you cannot use it
Yeah.
unless you're a real estate professional, right? I mean, you can use it, you just can't use it to offset your medical income.
Yeah.
So that one unfortunately had to go back and then return. They owed over $100,000 in taxes. So that was a less pleasant conversation because that had to be the bearer of bad news. But ultimately, it's always up to the taxpayer to decide, right? This is the exposure.
Yeah.
You obviously claimed a bunch of deductions that you shouldn't have, and so you have to decide whether you want to do it correctly or you just leave it as is and hope for the best.
Yeah, I mean, I guess that's it's a 50-50 shot in the dark, if someone's gonna, and that's scary. I mean, it's scary if it was $1,000, depending on, your income, that might not be too scary, but a hundred
Yeah,
thousand, 200, $300,000 difference obviously could, put you into a world of hurt. So, um,
yeah.
well, cool. I know this is, for one, been super helpful for people that are either just getting into real estate or, just have a couple of properties. I appreciate your time. There's a couple last questions. One, um, is there a book that you've read over the past, couple of years or years that you feel like has helped you outside of Rich Dad Poor Dad? I know that puts you on a springboard to where you're at today.
I recently read, last year I read the book, Who Not How, and by Dan Sullivan. And it was an amazing book. It really talks about scaling your business. And I think it, I apply it to all areas of my life, not just my business, but my real estate and also my home life too. So the concept is when you need to get things done, don't always be trying to learn it yourself, but find the best people who are experts who can help you do it. And I use that in my own investing too. Because I don't have time to take down large apartments, so I can invest passively in other syndication deals. They're the hoops to help me own apartments without me actually doing it. I think when it comes to taxes, right, who not how is important because as an investor, as an agent, it's not your job to become a CPA and learn how to do depreciation or any of that stuff, but you need a who on your team that knows all that, so you can just focus on what you do best.
Yeah, yeah, just like Robert Kiyosaki, Rich Dad Poor Dad, he talks about having his business advisors. So same thing, because you could spend years knowing all the knowledge that you've accumulated over the 15 years you've been doing it, and a person wouldn't be caught up to your knowledge base. So yeah, I love that book. That book's really good. And so, is there like an app, online resource that you guys use either investing or in your business that's really helped you guys be more efficient?
Oh man, so many apps. But since we're talking about tax and we're talking about real estate, and we talked a lot about real estate professional and how many hours you're doing. A question I get a lot is, how do I track my hours? What am I tracking? There's an app called Reps Tracker, REPS Tracker, and it's designed to help you track your hours and what you're doing. Whether it's long-term rentals or short-term rentals, it was actually developed by a client of mine who's a physician. And I
Yes.
was always showing people like, hey, you just use an Excel or Google Calendar. She said, is there an app? And I said, no, there's not. And a couple months later, she said, okay, I created an app. Can you review it and see if it's okay? And I think it's really taken off. We have seeing a lot of people. I'm hearing about it actually from other CPAs now too. So I
Oh,
think it's
really? That's cool. That's cool. Okay, yeah, we'll put that in the show notes. Well, I know you've written a book, and anything else that you could give out tidbits, or where people can find out more about you, and then you know this is your time to give some information about you, so people can come find you guys, because I think just for me, hearing you guys over the years, for one, you guys have grown exponentially, and two, you guys have really been those people that are, what's that book, The Go Giver. I feel like
Mhm.
you guys give so much information, so I really appreciate it.
Yeah, yeah. I know we didn't have a whole lot of time today, so if any of these strategies are kind of new or newer to you, definitely check out my website. It's keystonecpa.com. We have a free downloadable tax savings toolkit, and we go a lot more in depth about legal entities, real estate professional stratas, how do you pay your kids and get a write-off. And so I think that's a good starting point for people who are kind of new to tax planning. But I always try to give out, to daily tax tips. So if you want to follow me on social media, I'm mostly found on Instagram, and my handle is Amanda Han CPA. I've recently gotten a couple fake accounts out there now, and so make sure you're following the right one. I will never ask you for cryptocurrency stuff or like your financial information. So if I'm ever asking you for anything, that's not me. I'm only just giving out information.
Okay, cool. Well, Amanda, I really appreciate it. Thank you so much for your time today, and diving into some things that a lot of people either only know a little bit about, or don't know a CPA that can really strategize for them. So I appreciate your time.
Yeah, thanks for having me, Peter.
Of course. Bye.